Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. So far we have done some 10-11 problems on these dividend policies. Now I'm continuing the problems on Walter, Gordon and Modigliani and Miller approach. In this video, 4 more problems I am going to explain you. So before starting the problems, I expect my viewers to have a printout of the problems, which I have given in the link under my description. Always keep it ready and take the screenshot of the solutions of 4 problems I have written on the board. And after that, I'll explain each and every point in detail. Now, see the problem number 12. 12th problem I am reading out. From the following information, calculate the market price per share using Walter's model. Only we have to apply Walter's model. Rate of return 10%. Cost rate of return means internal rate of return R. So here R is given as 10%, 0.1, and cost of capital KE is given 12%, 0.12, and earnings per share E 15 rupees and dividend per share 4 rupees. This is the complete information given in the problem. We are required to apply Walter's model to find out the market price per share. Already we have applied in so many problems the formula to calculate the market price according to Walter. So here, according to Walter, the market price is P is equal to D plus R by KE into E minus D divided by KE. And all these values are given here. Only the thing is you have to substitute. D, in place of D, I am writing 4. R is 0.10. KE 0.12. 15. E is 15 minus 4 divided by 0.12. Now reverse calculation. From here you start calculating. 15 minus 4 into 0.1 divided by 0.12 plus 4 divided by 0.12. You will get 109.72. This is the market price per share. Finished. Now I am coming to the next problem, 13th. Calculate the market price per share of ABC Limited under Walter's model and dividend growth model. This dividend growth model is nothing but Gordon's model. The other name of Gordon's model is dividend growth model. So don't get confused. Now, earnings per share 5 rupees. So E is equal to 5. And dividend per share 3 rupees. 3. Cost of capital KE 16%, 0.16. Internal rate of return on investment R 20%, 0.2. And retention ratio 50%, 0.5. This is the complete information given in the problem. First we apply Walter's formula. According to Walter, the market price per share is P is equal to D plus R by KE into E minus D divided by KE. Now substitute. How much is our D value? 3. And R is how much? 0.2. KE is 0.16. E minus D, 5 minus 3. Divide by 0.16. Now reverse calculation, you will get 34.375 or you can write 34.38. So according to Walter, the market price is 34.38. Second method, it is asking you to calculate according to dividend growth model. This is nothing but Gordon's model. So according to Gordon, the market price per share is E into 1 minus B divided by KE minus BR. E stands for earning per share. It is 5 rupees. Whereas 1 minus B. B stands for retention ratio. Retention ratio is 0.5. Then KE, it is 0.16. B into R. That means 0.5 into 0.2. 0.5 into 0.2. So 1 minus 0.5 into 5, you will get 2.5. 0.16 minus 0.5 into 0.2 is 0.1. So 2.5 divided by 0.06, 41.67. That is the market price per share according to dividend growth model. That's it. This is the end of problem number 13. Now, problem number 14. The following information is related to the company X. Earning per share E is equal to 20. You can see here. E is equal to 20. Then rate of return IRR, that is R, is equal to 24%, 0.24. Required rate of return on equity, this is the cost of capital, K, 18%, 0.18. Calculate the market price per share under Gordon's model if the company follows a DP ratio of 40% and 30%. So in this problem, we are required to apply Gordon's model. So according to Gordon's model, the market price per share P is equal to E into 1 minus B divided by KE minus BR. Already so many problems we have applied. Now two situations are given, two cases are given. The first case, if the DP ratio is 40%. When the dividend payment is 40%, how much is retained? 60%. We require retention ratio for Gordon's model. We don't require DP ratio. So we can convert when DP ratio is 40%, retention ratio is 60%, 0.6. Now substitute P is equal to E. How much is the E value? 20. 1 minus B, 1 minus 0.6 divided by KE. KE is 0.18. B into R, 0.6 into 0.24. So 1 minus 0.6 into 20, you will get 8. Then 0.18 minus 0.6 into 0.24, 0.144. So 8 divided by 0.036. 222.22. 222.22, that is the market price according to Gordon's model. Now, if the DP ratio is 30%, second situation given in the problem, if the DP ratio is 30%, retention ratio is 70%, 0.7. Substitute P is equal to 20. 1 minus 0.7 B. 0.18 minus 0.7 into 0.24. So 1 minus 0.7 into 20, you will get 6. 0.18. 0.7 into 0.24, you will get 0.168. So 6 divided by 0.012, you will get 500 rupees. That is the market price per share according to Gordon's model. If the DP ratio is 30%, that's it. Now 15th problem. See the problem number 15. Calculate the price of a share of X Limited under Walter's model and Gordon's model, both. Earning per share 250. So you can see here E is equal to 250. Dividend per share 40. D is equal 80. Sorry. Dividend per share is 80. And cost of capital KE 15%, 0.15. Internal rate of return 20%, 0.2. And retention ratio is 60%, 0.6. So we are required to calculate the price per share according to Walter as well as Gordon's model. First we apply Walter. According to Walter, the market price P is equal to D plus R by K into E minus D divided by K. So D dividend is 80 rupees plus R 0.20, K 0.15 divided by E minus D 250 minus 80 divided by 0.15. You will get 2044.44. This is the market price per share according to Walter. Now according to Gordon's model, the market price per share is P is equal to E into 1 minus B. E is 250. 1 minus B. B is 0.6. Divided by KE 0.15. Minus B into R 0.6 into 0.2. Now 1 minus 0.6 into 250 you will get 100. Then 0.15 minus 0.6 into 0.2 is 0.12. So 100 divided by 0.03, it comes to 3,333.33. That is the market price according to Gordon's model. So we have completed 12, 13, 14, 15. So up to 15th problem we have completed till now. Now I am going to start the next problem, that is problem number 9. See the 9th problem carefully. ABC Limited has a capital of rupees 10 lakh in equity shares of 100 each. So each share face value is 100 and the total equity share capital is 10 lakhs. So we can find out how many shares are there at present. 10 lakh divided by 100, you will get 10,000 shares. Number of shares at present, 10 lakh divided by 100, 10,000 shares are there at present. The shares are currently quoted at par. So presently the market price per share is same, par value 100 rupees. So PO current price 100 rupees. The company proposes to declare a dividend of 10 rupees per share at the end of the current financial year. Proposed dividend to be paid at the end of the year, D1. D1 is equal to proposed dividend 10 rupees. The capitalization rate for the risk class to which the company belongs 12%, KE, capitalization rate. So capitalization rate is 12%, 0.12. This is the information given. What will be the market price per share at the end of the year if dividend is not declared and if dividend is declared? So we have to find out what would be the share value at the end of the year when dividend is declared and when dividend is not declared. That means we have to apply MM approach, Modigliani and Miller approach. Secondly, assuming that the company pays the dividend and has net profit of rupees 5 lakh and makes new investment of 10 lakh during the period, how many new shares must be issued? Use MM model, specifically given in the problem. MM model we have to apply. So before starting the problem, take the screenshot of the solution of these two problems, then I'll explain all the points. Now, see carefully. According to MM model, you can see the price per share at the end of the year is calculated as PO is equal to D1 plus P1 divided by 1 plus KE. Already in the previous problems also we have applied this formula whenever MM model is applied. So, if dividend is not declared, in two situations it is asking you to calculate the price per share at the end of the year. Market price per share at the end of the year. The first situation when dividend is not declared, that means we'll take D1 is equal to 0. So in the formula, PO is equal to D1 plus P1 divided by 1 plus K. PO is 100 rupees current market price. D1 0, no dividend is declared. P1 we have to find out what is the price at the end of the year. Then 1 plus KE, KE is 0.12. Now cross multiply. 1 plus 0.12 is 1.12. Now cross multiply P1 into 1. P1 is equal to 100 into 1.12, 112. So we got the market price per share at the end of the year is 112 if dividend is not declared. Now second situation, if dividend is declared, in both situations it is asking you to calculate the market price per share. Now dividend is declared, that is D1 is equal to 10. In place of D1, I am going to write 10. So PO is equal to D1 plus P1 divided by 1 plus K. PO is 100. D1 is 10 plus P1 divided by 1 plus 0.12. Now 100 is equal to 10 plus P1 divided by 1 plus 0.12 is 1.12. Cross multiply 10 plus P1 is equal to 112. P1 is equal to 112 minus 10. It will become 102. So 102 is the market price per share if the dividend is paid, and 112 is the market price if dividend is not paid. So first question we have completed. The market price per share dividend is declared is 102. Now second question, it is asking you, assuming that the company pays the dividend, company has paid the dividend and has net profit of rupees 5 lakh. The company is having a profit of 5 lakh. From this 5 lakh rupees, dividend has to be paid. And after dividend, how much profit is available? We will calculate. And makes new investment of 10 lakh during the period. How many new shares must be issued? The company has a new investment project which requires 10 lakh rupees. But the company does not have 10 lakh rupees. Retained earnings are only a small amount. The remaining amount has to be procured by issuing equity shares. So how many new equity shares has to be issued? That's what we have to find. If dividend is paid. Now first of all, net profit is 5 lakh. Given in the problem, 5 lakh rupees. Out of 5 lakh rupees, dividend has to be paid. How much is the dividend per share? 10 rupees. How many shares the company is having? 10,000 shares. Totally presently 10,000 shares are there. Each share dividend is 10 rupees. So 10,000 into 10, 1 lakh. So out of 5 lakh rupees, 1 lakh rupees will be paid as dividend. The remaining profit available is 4 lakh. Now the new fund required. How much fund has to be raised by issuing equity shares is equal to new investment minus profit available. How much total fund we require? 10 lakh rupees given in the problem. 10 lakh rupees we require. How much we are already having? 4 lakh rupees we are having. So we need a fund of 6 lakh rupees. By issuing new shares, we want 6 lakh rupees. Now tell me, what is the price per share when dividend is paid? Here it is. When dividend is declared, the price is 102. The market price per share is 102. So this the market price per share when dividend is paid is 102. Now number of shares to be issued are 6 lakh rupees we require, and each share market price is 102. So 6 lakh divided by 102, 5,883 shares. This 5,883 shares have to be issued. Right? That's all. This is the end of 9th problem. Now 10th problem. G Limited currently has 10 lakh equity shares outstanding. Presently number of shares are 10 lakh. Current market price per share 100 rupees PO. The net income for the current year is 3 crore and investment budget is 4 crore. Cost of equity is 10%. Now see the 10th problem. G Limited currently has 10 lakh equity shares outstanding. Current market price per share PO is 100. The net income for the current year is 3 crore and investment budget is 4 crore. So new investment required 4 crore, but the company is having a net income of only 3 crore. Cost of equity KE 10%. The company is contemplating declaration of dividend at rupees 5 per share. This is the D1. Using approach, calculate the market price per share if dividend is declared and if dividend is not declared. So first of all, we find out what is the market price per share at the end of the year in both situations. Now see here, PO current market price 100 rupees, KE 10%, 0.1, D1 is 5 rupees. If dividend is declared, that means if D1 is equal to 5, what is the market price at the end of the year? So according to approach, the market price per share at the end of the year is PO is equal to D1 plus P1 divided by 1 plus K. How much is the PO? 100 rupees. D1 5 rupees. Here we have calculated. D1 5 rupees. P1 we have to find out 1 plus K 0.1. That means 100 is equal to 5 plus P1 divided by 1.1. Cross multiply 5 plus P1 is equal to 100 into 1.1, 110. So P1 100 minus 5, 110 minus 5, sorry. It is not 100, it is 110 minus 5. You will get 105. So 105 is the market price per share if the dividend is declared. Now we have to find out if dividend is not declared. That means D1 is equal to 0. Then PO is equal to D1 plus P1 divided by 1 plus K. 100 is equal to 0. In place of D1, I am taking 0. Plus P1 divided by 1 plus 0.10. So 100 is equal to P1 divided by 1.1. So P1 is equal to 110. So when dividend is not declared, 110 is the market price. When dividend is declared and paid, the market price is 105. That's all. First question completed. Now second question is, how many new shares to be issued under both options? That means we have to find out how many new shares to be issued under both options when dividend is declared and when dividend is not declared. So number of new shares to be issued. Net profits are 3 crore, whereas new investment is 4 crore, right? The number of equity shares to be issued when dividend is declared. First option, when dividend is declared. So how much is the profit given in the problem? 3 crore. Dividend paid. 10 lakh equity shares are there. Each share 5 rupees. Each share dividend 5 rupees. So 10 lakh into 5. 50 lakh rupees will be paid as dividend. So out of 3 crore profit, 50 lakh rupees dividend paid. The remaining profit available 2 crore 50 lakh. This is the remaining profit available. Now how much is the new fund required? New investment minus profit available. The new investment is 4 crore and profit available is 2 crore 50 lakh. So 4 crore minus 2 crore 50 lakh, 1 crore 50 lakh is the new fund required. And what is the market price per share when the dividend is paid? Already we have calculated. When dividend is paid, the market price is 105. The number of new shares, 1 crore 50 lakh divided by 105, you will get 1,42,858. This is the number of equity shares to be issued to raise the required funds when dividend is paid. Now when dividend is not paid, number of equity shares to be issued if dividend is not paid. Now, how much is the net profit? 3 crore. Dividend paid, nil. We assume no dividend is paid. So profit available is 3 crore. Now new fund required. So what is the cost of the investment? 4 crore. How much profit available? 3 crore. So 4 crore minus 3 crore, 1 crore is the new fund required. And what is the market price per share if the dividend is not paid? Here we have calculated. If dividend is not declared, the market price per share is 110. 110. So here 110. The number of new shares to be issued, 1 crore divided by 110. You will get 90,910 new shares to be issued. That's it. So we have completed the problems on dividend policies. This topic is very, very important in examination. Every now and then they will ask. So you have to watch all the videos to get the complete command. If you are satisfied with my lecture, with my videos, give a like to the video. Share my channel in your group, in your friend circle so that more students can watch the video and enhance the knowledge. Subscribe my channel if you have not yet subscribed. And I have already started a new channel by name Khan's Accounting Institute for IGCSE students. Do visit that channel also and do subscribe. Inshallah, we'll continue the next topic in the next video.